Okay, good morning, everybody. It's the 5th of March. We are Signal Centre Talking Ball. I'm Joe Neighbour, joined by Sweaty Steve O'Hare. How you doing, Steve?
Morning. Yeah, a bit warm this morning. Just been on the Peloton. But Steve,
Getting the blood flowing.
yeah,
I love that.
yeah.
Good
Oh,
on
it
you, mate.
did get the blood flowing.
Good. That's what it's there for.
I might have to attach a heart monitor to me with a little emergency call button.
Yeah, definitely. Ripcord.
Yeah, just watch that heart rate. Markets have been a little bit spiky as well, haven't they?
They have, yeah. It's all go. Obviously, it's non-farm Friday today, so markets should be gearing up towards that announcement at 1:30. So in terms of what's moving markets, we had Brent crude yesterday. That's holding on to its two-day gains of about 5% after rallying on headlines coming from the OPEC Plus production talks. It was a surprise move from the alliance. They agreed to hold output steady in April. Saudi Arabia said that it will maintain its 1 million barrels a day voluntary production cut, and that led to investment banks like Goldman Sachs and JP Morgan boosting their forecasts for oil. In terms of the markets, which we'll come on to shortly, talking about equity markets, the Nasdaq Composite wiped out its 2021 gains, and Tesla got a bit of a battering. So yeah, a number of these stocks that have been classed as lockdown winners have dropped, and we've also seen equity futures lower this morning. So it's all sort of combined. We've got what's going on with oil, we've got what's going on with the equity markets, and we will talk about what's going on with things like dollar index and euro dollar as well, because there's been some quite significant moves there. Steve, do you want to run us through some charts?
Yeah, I'll jump on the commodities actually, because they're the interesting one at the moment. Again, we don't want to sort of say, we're not always right with things, but we've been calling this rally higher in the oil for a very, very, very long time now, and it has been sort of almost a one-way move. We've had a bit of a retracement when we got to the 61.8% retracement level at 51.27. It had a retest of the breakout, and then carried on up towards the 78.6, and we're now through that, and we're really back to levels of early last year. Well, the high of last year, Jan 2020. Also looking to target the April 2019 move. So just coming up to that now. Let's get it on the daily chart to give a little bit of an indication of what we saw. We saw the initial price rally. This was on the 25th of Feb, up to 63.70, and we saw a nice little correction when the OPEC nations were talking about, or where they had the freeze in West Texas, and the inability to actually get the oil out. But then there was obviously, we found out later also, the demand dropped as well, and then things picked up. And now the OPEC plus nations, Saudi Arabia, as Joe said, agreeing to the voluntary million barrels a day cut, and everyone else agreeing to extend the oil output to cut into April. Obviously, this works out well for them. So they can now sell what they do sell at a higher price. But here we have the 65.21 price. We're not far away from it, just a spitting distance. On the Brent side of things, it's a little bit different. Obviously, trades at a premium to the WTI crude oil, and it's got a little bit further to go, really. We've got another $2.50 really to hit that high from last year, from January last year. So still looking very positive on the short-term chart. I think really buying dips is the same. It is a sort of like continued approach. You're going to get a bit of profit taking up here, but I think dips can be bought around about the 63.65 level, down about here. That'll be nice to get a retest of that before extending higher, as obviously things don't always go up in a straight line, just like this candle shows. They have the pullbacks as well. Also looking at gold, and that continued lower. And we've sort of, the levels we were talking about, or I've been talking about on gold, I'll be talking about the long-term projection higher, but obviously the risk of this pullback in this channel formation. So we're really watching this quite closely. It's got down back to levels that we consider quite significant. 1670 for me is a really key support to hold. If we don't hold there, then it could open up a potential sell-off all the way down to $1,450. That might be pretty, and I don't know what the catalyst will be for that, but I think it could be even. We could even get the indices coming off at the same time as gold, which we saw last year quite aggressively.
We did see gold trading like a risk asset for most of last year.
This was the 16th of March sell-off. We saw it move from 1700 to 1450. We're trading at 1700, so that only took a couple of weeks to move down there. So these things can happen rather rapidly. So be very careful with gold longs. As I say, 1650 to 1670, a real line in the sand for me. I'd be bearish on the medium term below there. Obviously, long term, I'm still looking for the move higher. Even if we do get down to this 1450 level, I still consider the market to be bullish over the long term. I'll leave the dollar index for Joe. On the treasuries, we're looking at the treasuries. Obviously, we saw a 30-year move up to 235 on the yield, and a 10-year move, a new high, which we haven't seen these sort of levels since February last year. So quite significant levels. I'm not completely convinced by the yield rally. I think it's more of a technical move higher, but could be wrong. So just be aware of those levels. If we see them levels spiking higher, then there's obviously money will prefer to go into an asset such as a 30-year rather than the higher risk assets such as indices.
So Powell yesterday didn't really address it.
No.
He was continuing to be very dovish. He said, well, he didn't really say a lot. I think markets wanted more from him in terms of addressing the yields.
Yeah, he sort of sat on the fence a little bit, didn't he?
Yeah.
So I don't know. It's you need someone like Greenspan to take the bull by the horns, I think. But
I mean, he barely acknowledged it, according to this report. He sort of just gave it a minor nod. I
think I did see one line comment, and I just thought, oh, well, that's not really a lot. And then the market did take it more than what he said. So it sort of, the market seemed to overreact a little bit to it, but that gives him the sort of, like, I suppose, a few more bullets in the barrel if he needs to use it at some point to either support or not the markets. So we saw that this is what we saw on the FTSE basically last year. We've seen the really nice correction higher in this corrective channel. And over the last week, or sorry, this week, we saw the market really rally strongly and then sort of have a real vicious turnaround yesterday. I've still got this head and shoulders formation up here. It looks a bit cluttered, so I'll just take it off. Still a potential for it. You still see the shape there. Obviously, dollar strength helps FTSE out. So that's one thing that the FTSE can be grateful of. We saw basically the turnaround on the 1st of March. Nice start to the month. Bullish engulfing, and we saw the spike higher on Wednesday and the sell-off yesterday, bearish engulfing candle yesterday. We've had a further spike lower overnight, but we've recaptured those gains. We're trading around 6,600 in the FTSE. I think maybe worth selling into rallies, but a break above the 67.06 level, 67.10 say, and we could sort of like retest the 68.11 level. DAX doesn't look as pretty. These are sort of like quite significant reversal candles, hanging man, shooting star, a negative doji, and again, a bit of indecision today. We've had a bit of a sell-off, and it seems to have stalled. So potential here for, let's drag this arrow here over here. I could duplicate it and make it a triple top potentially, but there's potential for a double top here if we get a break of this level, 13,643 in DAX. I mean, it's a significant move lower. It's 300 points lower. The average range for DAX is about 220. So potentially won't see that today, but maybe if we do get a poor non-farm payroll, this could lead to a little bit more indice weakness, and we could sort of be knocking on the door on a Friday night at this level, and then who knows what might happen over the weekend. I'll go to Dow Jones. Obviously, we've talked about this ending wedge formation. Let's draw this line in correctly. Extend it to the right, and that looks a lot better. That looks a lot better, that line. Didn't quite get to it yesterday, but potential for a break of that today. So you should get some sort of support, but if that doesn't hold, we could be targeting a move to 29,000, well, around about the 30,000 level quite easily. So that's the Dow warning today. Nasdaq, as Joe said, has had a really significant down move. I'll take these projection levels off. And it's the head and shoulders formation. We highlighted this before, and we had this as a neckline, and we drew it around my birthday, 24th of Feb. And then we had the move higher, retest the right shoulder. So it's a bit of a complex head and shoulders, but they're normally pretty good ones. Now we've broken through the neckline. There is potential for a retest. So for me, 12,735 would be the prime entry location for shorts on this move. I think Nasdaq seems to have had, I don't really want to say it's had its day, but it is due a big correction. So normal correction would be 38.2, which is 11,130. So that's a fair correction, but we'd still be bullish. So it's not sort of saying the trend is changing. It's just we're sort of getting that corrective move. So yeah, negative on the Nasdaq. S&Ps, again, nice supported trend line, broken through it yesterday. That looks a bit ominous for the S&Ps. We need a really, really good rally to negate these negative thoughts from my bare head. Let's redraw this line as well. Quite easy to do. Just take the 2 points and then extend it right, and we can see on the Aussie 200, very predominantly commodity based, and that has seen support overnight and rallied higher. But again, a break below the previous swing low at 66.50, and we could easily see this be retesting the 6,500 level. So negative on that. Nikkei, it's broken out of this interim bull channel. Again, if we extend it right, we can see how much is broken out, and it looks to be heading down towards this. I mean, bullish hammer at the moment on the daily chart, so that could sort of offer us a glimmer of hope. But I think if we start to see the lows again, we'd have this support on the way to the upward trending channel line, the bigger one. That comes in at 27,587, so about 1,200 points lower. China's been negative for a while now. That had the turnaround on the 18th of Feb and has broken down through the previous swing low. So I would expect a nice AB equals CD sort of correction, something like this. So that's the sort of thing I'd be looking at, and maybe really, why not target a move to 16,438? So yeah, overall, feel a little bit bearish of the indices. Mind you, I felt like that for about 15 years, and they have only gone one way. There's these opportunities in the sort of like the rally high that I have been right, but yeah, it doesn't look too rosy at all for them.
No, indeed not. Okay, great. Thanks, Steve. So on to the FX side of things. So first up, again, looking at the overview of currency indices, just to give you an idea of what's moving where. And notably, we can see this blue line here, which is the dollar index, is starting to perk higher. It's the only really currency out of all these ones that we're following that is actually starting to do a bit of trending higher. We've seen sell-offs in the Aussie and New Zealand dollar currencies, so people backing out of riskier assets looking for safer havens such as the dollar. That's not shining through, however, still in Japanese yen and Swiss franc. They continue to be shunned really by the market. No real interest there. We're also seeing the euro starting to tick lower as well. So some interesting goings on in FX, and it's all being driven by the dollar. So let's take a look at that on a standalone basis. Here we've got the daily chart, and this was the level that I was speaking about yesterday. Oops, I was keeping an eye on this 91.60 level. I felt that was sort of the key level that needed to be taken out for the trend to really sort of show some signs of changing. Now, by completing this mini kind of bottom pattern, I think we can start to project targets quite a bit higher. We've got 38.2% fib level up here at 94.46, and we've got a measured move target of this measurement here from the lows on the 6th to the highs on the 4th of Feb. Projected higher comes in at just under 94.00. So I think now it's a case of buying anything dollar related. I think we're going to continue to see a push higher in the dollar index over the coming weeks. So for me now, it's a case of probably being a bit safer in the approach with currency trading. And if we have a look at euro dollar on the flip side of this, often the chart is sort of a mirror image of what goes on with the dollar index. We can see here we saw this break of the channel. That was back in the beginning of February. We saw a retest, quite a nice retest of that on the 25th of February, posting a shooting star candle. And now what we're doing is taking out this low from the 5th of February, which was the first sort of reaction from the break of the channel. Now, by taking that out, I know we haven't done it on a closing basis yet on the daily chart, but I think that sort of sets up a move quite a bit lower on euro dollar. In terms of targets, if we take a measured move of that correction down there, then we're looking at a move down to sort of 115.56, and that probably comes in line roughly, well, just below the sort of supports we've got here at 116.12. In terms of fib levels, let's have a look what we've got just to see if there's any kind of confluence. I mean, first port of call will be the 38.2. So we've got, quite a big area really there of where it could potentially head to on a break below this 119.52 level. So I think it's a case of selling rallies in euro dollar, providing that we see a closing break below this level today at 119.52. Elsewhere, so as we mentioned, risk currencies, we've got Aussie yen. I mean, the yen has continued to be weak, so this is sort of keeping this up at elevated levels and keeping it within this bullish channel. If we look at Aussie dollar, it's slightly different. And again, like euro dollar, we're seeing a breakdown of support here. The support comes in on Aussie dollar at 76.92. A closing break below this level, and I think we could see this correction come quite a bit lower. Obviously, there's a fair amount of unwinding to do on this because it's had such an enormous rally from these March lows. So there's plenty of room for these currencies that are linked to the dollar to have a substantial correction. And I think, again, I'll be looking at that 38.2 level. We've got some resistance there, then turn support. So that would be a sort of an obvious level for me. So I think it could be a case of looking to sell rallies on this one as well. On cable, because of sterling strength, again, this is sort of staying up at reasonably elevated levels. We're still trading arguably within this channel. We had a little bit of a poke above it, but we're back within. So I'd be looking for maybe some support to form around here at 37.59. If this level gets taken out, along with the channel, then again, I'd be looking for probably continued dollar strength over sterling strength in the coming weeks. So an interesting time, I think, certainly more interesting than it has been in FX. You're getting these potential turning points in the market. And, as technicians, when we're seeing these sort of patterns, it's hopefully when we can sort of cash in and do quite well out of it, because you start to get follow through in the markets, and and that could lead to big returns. So potentially an interesting couple of weeks ahead, I think.
Yeah, absolutely.
Okay.
With non-farm, really, isn't it? Non-farm could be a little bit of a bit more of an interesting number than it has been of recent years.
So the past two payroll releases have come in at minus 140 and then plus 49k. So it's put a lot of pressure on today's figure to finally show an emergence from this period of weak job creation. I've got here payrolls expected to rise by 115k from that previous 49k build a month ago, and an unemployment rate expected to hold around about 6.3. So those are the key levels to keep an eye out for today.
Excellent.
In terms of the gun to the head trade ideas, we didn't do too great yesterday, unfortunately. You were very unlucky with your gold trade.
Yeah, I was a bit annoyed about that. But that's what you get when you have your stops too tight.
Yeah. So there it is, just to confirm. We had an Aussie Swiss trade. I was just a bit too early on that one, really. It did actually continue lower, but tight stops, as we said, going for glory. And Steve was very much the same. I think he was stopped out by a tick on that before it actually went on to go and hit target. But dust ourselves off, Steve, and go again. What have you got today?
Tough one today. I can't really sort of, I'd buy a dip in oil. I wouldn't buy it at these levels. It's too risky. A little bit the same with the gold. So I think I've got to really go for an indice that maybe offers a little bit more in the way of potential. So I'm probably nicking your trade idea.
I haven't got one at the minute, so you got a free hit.
So yeah, I think really for me, it's ideally I'd like to sell up at these levels, 14,000 in DAX. So let me get short at these levels, 13,953. The stop at 14,023 because I like the number 13, and I'm going to go for a 3-to-1 risk reward already on side. Lovely. 13,743 the target. That's me. 3-to-1 risk reward on the DAX. DE30, GER30. In this one, it's GRXEUR. So,
okay,
whatever.
All right, I'm going to take a look at cable. Actually, just had a flick through the charts. Obviously, we talked about dollar index now looking a lot more positive. So, in answer to that, this is the daily chart. So, bit of room down to this trend line down here. So that's really what I'm going to be trying to take advantage of. If we look at the intraday charts, let's just get rid of those drawings. So got a bit of a breakdown here, as you can see. So broken down below that low that was posted on 2nd of March. Ideally, be looking for a bit of a retest of that to confirm that we have a decent breakdown there, but we're not getting it at the moment, and I've got to get in. So I'm going to sell it now at 138.39. Stop loss at 139.14. I don't know if I like that, actually. It's probably a bit too high. And let's try something here. Just give ourselves a bit of a target on the downside. 137.03, and let's tighten that up to there. Stop loss at 138.94, targeting 137.03. Looking for 2.5 hour on that one today.
Nice.
Okay, so there's two trades for you to take a look at. Aside from non-farms, we've got trade balance from the US, which is also due out at 1:30, and then at 3 p.m. we've got the Canada Ivy PMI figure, previous reading of 48.4. So keep an eye on CAD crosses, and obviously they'll be influenced by what's going on with oil as well. Steve, just before we go, one of the viewers has asked if you foresee an upturn in Liverpool's home form anytime soon.
Yeah. Obviously, the viewers don't know what they're talking about. You can't. Form
He's got his head in the sand in that photo, so I imagine he's a Liverpool fan as well.
Form is one thing, quality is another. Quality will never leave us. No, yeah, absolutely. Shocking to sort of watch again last night, but it's just one of those things. They're sort of like that. They look exhausted. They look like a sort of like a tired team. The front three aren't firing. You've got the heart of the team has been ripped out with Henderson and Fabinho not in midfield, and Van Dijk and Gomez not in the centre of the defence. So, when you take that out of your team, you're going to really struggle. They're still trying to play the same way that they did last year, which worked really effectively and really well. But they had the players in the right positions to do that.
I think it's always been a concern for Liverpool. You just haven't got the squad depth. You've been flogging the same 15 players for the last 2 seasons, and they're going to burn out at some point, as you've seen with the injuries. And
it's also
you need some more depth.
I think you do, especially with the way the style of play. It's all right when you sort of like get teams like Tottenham and Chelsea and Arsenal just sit back and park a bus, but you sort of when you get, Man City obviously is like the best team in the league by a long way, best team in the world, I think. And they've got that strength in depth. They've got 350 million sitting on the bench, so very hard to compete with them. Last year, Liverpool absolutely trounced them, but I think that was again because their defence was shocking. So if you're going to play that high pressing attacking game, you also need a bit of an alternative to sort of like think, right, okay, let's play this, play the same, all these people at their own game, sit back a little bit more, don't press too high if you haven't got the men to do it. It's written off this season. Maybe the Champions League we might get a bit of a run, but we need to get the top four, I think, to sort of like guarantee Champions League next year. It's still possible, but last night was a real sort of that was the game we had to win last night, and I think we need a bit of luck. We need a lot of luck now.
Yeah, never mind, Steve?
No,
you could be an Arsenal fan.
I'm still thinking, world champions, champions of Europe, champions of England in the last year or so. So, I don't know when many teams that can say that.
Yeah, well, thanks for that, Steve. I'm going to cut you off now. Let's wrap it up for the week. Good luck if you're trading today. Keep an eye out for non-farm payrolls at 1:30 and some increased volatility around that. And we'll be back on Monday morning.
Cheers.
Cheers, then. Bye.